All right, well done. How are you doing? Thank you for joining this channel. If you are a new subscriber, I welcome you to this channel, Blessed Institute. And if you are a returning subscriber, thank you so much for being part of us. And if you are just watching this video and you have not even subscribed at all, I'm indulging you, imploring you, persuading you that you subscribe to this panel so that you can be having access to the subsequent video that will be dropping on financial reporting, performance management, and other related courses that are Ican inclined. All right. The other time we were solving a particular question in class one, I've explained some of the terminologies in income tax, and we have been able to illustrate some examples. We started another questions in that first class, which we are going to complete now, and we are going to move to the other ones that's needed to be solved, just to ensure that we we have proper understanding of income tax, because it has been noticed that most students, they don't actually have proper understanding of income tax, and ICANN kept on setting the question almost every diet. So this diet is your diet. You need to buckle up, sit tight, and the Lord will help you. So the question we were solving, if you remember, it was actually the example, one of the examples in ICANN study pack. This particular question you are seeing here that talks about the X limited made accounting profit, etc. So I've explained how you can get your carrying amount. I've explained how you can calculate your depreciation. We are asked to calculate depreciation using straight line method. We were given the parameters for calculating the depreciation and the capital allowance here now. The capital allowance is just an assumed figure. It was not given in the question, so they just assumed the figure here. So they assume 4,500 for the year one, 4,500 for the year one, 2,500 for year two, and 3,000 for year three. So if we put everything together, 2,000 for year three rather, we put everything together. Let's come back to our what? Our calculation. So we have what? We have our 4,500, which capital allowance for year one, 2,500 for year two, and then 2,000 naira for year three. So if we subtract this from what we have over there, we are going to have this figure 3,000. You are going to have 51,000. So that's our taxable profit. Then we are going to what? We are going to calculate our tax liability now. Tax liability. Tax. So we have this. We come to this one. It's equal to 30% times D29. Then we have 30% E29. E29. So these are the tax liability for our what? For 20x1, 20x2, and 20x3 year of assessment. I believe that is well understood. That is well understood. Let us consider another example. Enugu Trader Limited had an accounting profit of 80. This is supposed to be 789,000. It is not 89,000. It's supposed to be 789,000 for the year ended 31st December 2018. The accounting profit was after depreciation of 70,000. That means before they arrive at that accounting profit, they have already subtracted depreciation and included in the profit a disposal capital gain of 97,000. That capital gain is what? Is not is disallowable income. Are we getting like that? Then we have The company had incurred borrowing cost of 70,000 in the year, of which 10,000 has been capitalized in accordance with IAS 23. At 1st January 2018, the tax treatment value of machinery was 120 and for building was 600,000. So we have two assets here. So they said tax regime, all borrowing costs are deductible for tax purposes. Capital gain are not taxable. Capital gain are not taxable. Whatever transaction that has to do with capital gain, you have to go and adjust it, or to go and take care of it in your under your capital gain tax. It should not come to this place. Sales proceed is what? Is disallowable expenses. Is disallowable income rather. It's not deductible. It's not deductible. Then we have fines are not deductible. Fine is a disallowable expenses. Are you getting me now? Account depreciation is not allowable. Yes, depreciation that is being charged, account depreciation is not an allowable expenses. We have capital allowance is claimable at what? At 10% per annum for building and 15% per annum for machinery. Applied to tax treatment value at the start of the year. Tax is paid at what? At 30%. So this also is asking us to calculate our tax liability, and possibly we should calculate um our deferred tax. But let us still try to limit ourselves to that requirement one, which is asking us to calculate our tax liability. So let us go to our question. Let us go to our spreadsheet. The name of the company is Enugu Trader Limited. Computation of tax liability. Computation of tax liability for which year of assessment? What is the year of assessment? 2000 x 8, 20 x 8 for 20 x 8 year of assessment. So let us put our measuring value here. Okay, let's just put it here like that. So we start again from accounting profit. Accounting profit. So what's our accounting profit? 789,000 naira. 89,000. Then having gotten our accounting profit, what's the next thing? Next thing is to what? To add disallowable expenses. Such as what? Such as depreciation. Meanwhile, depreciation here, let us check the question. We were told that 70,000 naira, the accounting profit was after depreciation of 70,000. So 70,000 naira is our depreciation. 70,000. So if we add the two together, that should be 195,000. Let us try to add the two together now. So that is the cost. Then we will now subtract all income that are disallowed. All income that are disallowed, that you are not expected to have recognized as income, but you have already recognized them as income. And also the expenses that are allowed, that you have what? That you have disallowed. So we have capital allowance. less admissible deduction, less admissible deduction. So we have capital allowance. We have capital allowance. Let us come to note here so that we can calculate our capital allowance in the workings. We were told that building is what? That building. We were told that the tax value of machinery was 120,000 and that of building 600,000. Plant and machinery, that is 120,000. Then building. Okay, let us calculate capital allowance for machinery now. Capital allowance for machinery for plant and machinery, which we have calculated. For building now, for building, we will try to do that as well. The cost of building, the cost is 600,000, and then the capital allowance according to the question now is 10%. 10%. 10%. Then we say that so that means the depreciation now is 18 and 60. So we can now come here, and say capital allowance, which is what? Which is the combination of 18,000 plus 60,000, and that one is going to give us 78,000. We haven't done that. Let us check the question. What are those items again that are not admissible? We have a borrowing cost that has been capitalized, 10,000 naira. So we'll bring it here. It has been capitalized. Borrowed cost, 10,000 naira. So I haven't done that. Let's check again. What item do we have that here? Disposal gain, 97,000. Disposal gain. Disposal gain, 97,000. 97,000. What other item do we have? There is no any other item that must be what? That must be that is not admissible. We don't have any. 185,000. So this 185,000 is supposed to come here. 185,000. Then if we subtract E8, E8 minus E13. So these are what? These are what we call our taxable profits. These are taxable profits. Taxable profits. Then we now charge tax on it. Tax liability now will now be 30%. We were told that it is 30%. So we come here. That is E. So these are tax liability. These are 339,700. XPLC has non-current assets with a carrying value of 200,000 and a tax base of 140,000. It has recognized a receivable of 10,000. This relates to income which is taxed on cash basis. It has also accrued for an expenses in amount of 20,000. Tax relief is only given on this expense when it is paid. At the start of the year, XPLC had a deferred tax liability of 12,000 required. Show the movement on the deferred tax account and construct the journal for this record. So this one is asking for movement on the deferred tax, whereas there is no way we can we can do the movement on deferred tax without knowing our deferred tax. They will give you the deferred tax at the beginning and deferred tax at the close. We were told that the deferred tax at the start of the business or at the start of the year was 12,000, and at the end of the year now, what is the deferred tax? And that will take us to the computation of temporary difference and permanent difference first. So temporary difference first, and after we have gotten that one, we will check whether it is deductible or it is taxable. Then we will compute our deferred tax. After we have computed our deferred tax, we can then move to the computation of movement of deferred tax. So let us solve. So first of all, computation. The name of the company XPLC. SPLC computation of deferred tax. Don't forget the definition of deferred tax. Don't forget the definition of deferred tax. All right. So in that wise, we have the item. We can prepare it in table format just for simplicity purpose. You can prepare it the way you want to prepare it, whichever way, either vertical or table format. But for simplicity purpose, let us use table format. So we have item, we have carrying amount, then we have tax base. Another name for tax base is tax treating that value. Then we have temporary difference, and after then we are going to have our deferred tax. So now, taking the item one after the other. Take the item one after the other. Let's go back to our questions. We're told that the carrying amount of non-current assets was 200,000 and the tax base was 140. This one, they have already calculated your carrying amount for you. There are some situations whereby you will be the one to calculate your carrying amount by yourself. And don't forget, in that wise, you will just subtract your depreciation from your cost of an item. Then you get your carrying amount. And that of taxing that value will subtract your capital allowance from your cost. Then you arrive at your tax base. Let us see non-current asset. Non-current asset. So the carrying amount for that is 200,000, and the tax base is 140,000 according to the question we were given. So deferred tax is the temporary difference is the difference between the carrying amount and the tax base. And don't forget what I said at the beginning of this lecture, that your temporary difference can be taxable temporary difference or deductible temporary difference. It is taxable temporary difference when your carrying amount is greater than your tax base, that is tax laid down value, and it is deductible. Okay, in that wise, if your carrying amount is greater than your tax base, it is taxable, and that is liability. But in the same whereby your tax base is greater than your carrying amount, that is what? That is deductible temporary difference, and that is an asset. That is the tax authority, you have overpaid the tax authority, they need to pay you back. Do we get? Now we have 40,000 as difference. Then temporary difference 30,000 is 60,000. Sorry, please. It is 60,000. Then our deferred tax, we were told that the tax rate is 30%. So just say that equal to 30% of G4. Sorry, supposed to be 30%. So that's our deferred tax. Then we come to the second item, which happens to be receivable, and we're told that it has recognized a receivable of 10,000 naira. This relates to income which is taxed on cash basis. When income is taxed on tax basis, the tax base of that income is 0. That means the receivable does not have tax base. Receivable. The carrying amount was actually 10,000, but the tax base is dash. Therefore, our temporary difference is 10,000, and then our deferred tax is 30%. 30% of F5. All right, let's go to another item. That we have in our question. We're told that it also accrued for an expenses. So we have an accrued expenses now in the amount of 20,000. So accrued expenses, it is an expenses. That means it will be in bracket, it will be minus 20,000. Then it does not have any tax base as well. Tax base is 0. Therefore, our temporary difference will be what? It will be 20,000, making us to have a deferred tax. No, a deferred tax that is what? That is deductible this time around. That is an asset.
we have paid on an expenses which should be recovered 30% of F6. Then we now add the 3 So these are deferred tax. Now come here, call it deferred tax. I believe we are getting it. These are deferred tax. It doesn't end there. We now want to calculate our movement. We want to compute our movement. Movement in deferred tax now. Movement in deferred tax. Movement in deferred tax. So we have the balance at the start. At the start of the year. Let us put Naira sign. Which happens to be 12,000 according to what we have in the question. Then we have the balance that is going to income statement. The balance that is going to income statement, which is the balancing figure. We don't know it yet. Then we have balance at the close. At the close of the year. Just as balance PD. And we were told that that should be what? That should be 15,000. So this one is the middle, the one that is at the middle is balancing figure. That means when we add this one that is here together, the one that 12,000 and the balance that is the amount that is going to income statement, the tax for the year that is going to income statement, when we add it together, it must give us 15,000. Therefore, we just subtract 12,000 minus 15,000. That gives us 3,000. That means the income statement or the income, the deferred tax that should be recognized in that year should be what? Should be 3,000. I believe we all get the movement. Let us see how they put it in there. This deferred taxation balance at the start of the year, which is 12,000. Statement of profit or loss as balancing figure, and then deferred taxation at the end of the year, which is 15,000. Then the journal, you will debit your income statement now. When we are preparing your income statement like that, deferred tax will come under expenses as tax expense, then deferred tax liability account will be credited. Do we get? Because the liability account. Do we get it like that? So as we are done with that one also.